Hey, everybody, welcome to our Wednesday Sales Mastery Training. My name is Mario Delgadillo out of Dallas, Texas. And today we're going to talk about, or actually walk through, the newest version of our financial seminar for new agents and how they're getting out into their market. So again, as somebody comes into the agency, right? Let's say somebody's brand new to the agency and they say, Mario, listen, I know we buy leads here, okay, but I do have some friends that I want to get, their eyeballs on this. Or Mario, I want to buy leads, but I have to drum up some cash so that I could buy those leads. Typically, what we do is we have them do a financial seminar, and the way the financial seminar is set up is it's not a sales pitch, like, hey, come and buy something. So our, like for instance, Glenn Tompkins, one of our newer agents, he just sent me a text the other day, and he was like, "Man, this texting script is super easy, right?" So what we do is number one, we pick a night during the week, right? So Monday, Tuesday, Wednesday, Thursday, Fridays usually never work because nobody wants to be in a meeting on a Friday night. But Monday through Thursday, I've even done meetings on Saturdays where it's a Zoom meeting, and what happens is, let's say I'm going to reach out to Sharina, right? So what I do is I send a text message to Sharina, and the first thing I do is I clear the time. Hey, Sharina, what are you doing on Thursday at 6? You free? Right? Now, if Sharina's my friend, she's probably going to think that I want to, hang out or go get something to eat or whatnot. So nothing, I'm free. Why? That's important because if you clear the time, they can't come back and say that they're busy, right? So, hey, what are you doing on Thursday at 6? Are you free? Yeah, I'm free. Why? What's up? Listen, hey, I need a huge favor. Okay. What's that? Listen, I don't know if you know, but I just got licensed as a life insurance agent, and I focus on wealth management and asset protection. And anyways, I don't want to sell you anything, and I'm not trying to recruit you to anything. Okay. But I need a certain amount of observation hours under my belt in order to get certified so that I can kind of do this thing on my own. Would you do me a huge favor since you're not doing anything anyways? Can you jump on a Zoom call so that I can get your hour counted for my observation? Right? Guys, for those of you that have done this, we get people to show up. It's not difficult, right? People are like, yeah, I'll jump on, right? And then what happens is when you start the meeting, okay, you as the host, right, and then the person who's actually presenting continues to kind of say the same thing. Hey, guys, we're not here to sell you anything. We're not here to try to recruit you to anything. What we want to do is we're trying to get Sharina for observation hours. So if you guys stay on to the end, keep your camera on to the end, and also hold your questions to the end, she'll get counted for your hour. And we go through the financial seminar. Now, the idea has always been, right? I think for those of us that have done our financial seminar, we know that we always get at least one client per meeting, most times 2 or 3. She had 3 people show up. It wasn't really a true one because I moved the date. But she had 3 of her best friends come on. 2 of them we have calls with. So the numbers are really, really good in our favor. But we go through the information, and the idea is that the information is so good that at the end, I typically say this, hey, basically, guys, we're done. And I want to throw this out there because sometimes in the course of this presentation, some will start turning, some light bulbs go off. But if you guys are interested in having Sharina run any numbers for you to see what like a participating whole life product could look like for you, it's free. I'm sure she'll text you later about it. But anyway, Sharina, why don't you jump on and say goodbye to people, right? That's as simple as it is. And I always get text message back, hey, yeah, this person wants to talk. They want to learn more. And it happens every single time. So that's the setup. That's what this is all about, right? And then once you go through that process 2 or 3 times, you get a couple of commissions, you get paid, and then now what you do is you invest that money into leads, off to the races. Any questions on this process? Is this pretty good, pretty simple, right? So what we're going to show you today is it's not finalized, but it's the next version of this financial seminar that is not catered to IUL and or annuities. It's wealth principles, right? Wealth strategies of the rich. So let me go ahead and pull that up, and I'm going to show it to you guys, and we're going to walk through it. A lot of it is information that we've already seen before, but it's restructured. The story that we tell is different. I'm thinking about, so keep this in mind as we go through it, I'm thinking about adding a section on the end that says that wealthy people create guaranteed income sources, multiple, right? How do they do that? They invest in a business, right? Where they start to earn money that comes, right? They invest in real estate where money continues to come, right? But remember, this is for everyday average people. So most people are like, yeah, I should go and drop $500,000 in a business, right? They can't, right? So how else do we do that? Well, we utilize people's retirement accounts and we create a guaranteed income as well. And I'll show them some facts and figures. That's not on there yet, but I'm kicking that idea around. I've got to put it in. If I put it in, it's got to be condensed enough and simple enough that it's powerful enough to make its mark, right? So that they want to know more, but that it's not too much information that I lose them. Does that make sense, guys? Okay, so let me go ahead and open this up. And hopefully y'all can see this. All right, so for those of you guys that do have your camera on, as you guys know, camera's on for me always. I was on a call this morning and nobody, it was 29 people and nobody had their camera on. And the host asked, he said, if you guys can, for those of you that are able, please put your camera on. He said, he goes, to me, being on a Zoom when people have their cameras off is like sitting around a campfire and people have ski masks on. It's just really awkward. And I started laughing. I was like, yeah, it's like covering your face, but sitting around a campfire, right? So again, if you're able to, thank you guys for having your cameras on. All right, so let's go ahead and get into the information. So Wealth Strategies of the Rich Financial Seminar. There's our leaders, our executives, right? Again, this gives validity, right? Validates who we are. Talks about who we are as a company, right? Our unique value proposition is that we're not captive to any particular company, which means we don't have any quotas, nor are we bound to recommend any specific strategies. Our loyalty is to our clients. So what we do is we provide strategic and dedicated retirement planning and asset protection to everyday average people like you and I. Now, this allows us to take more of a holistic approach to servicing our clients by listening to what's important to them and then taking them and connecting them to the appropriate carriers or financial institutions. Now, what do we want to talk about first? We want to talk about how the wealthy handle taxes and inflation because they do things that are very different than you and I, okay? So let's talk about taxes first and foremost, okay? I'm not going to cover fees. Hold on. So make a note, that's got to go. So there's three ways to look at taxation, right? There's you pay your taxes now, okay? That's cash, right? Or any type of income that you earned, you're going to pay taxes on that this year, right? Pay your taxes later. That's like a 401k, 403bs, or IRAs, right? And then there's pay your taxes never, right? And that's Roth IRAs or what we call LIRP, which is life insurance retirement plans, right? And there's a couple different types. So with that being said, I like to share with people this particular illustrative story called The Seed or the Harvest. And really the seed or the harvest is really just, should somebody pay their taxes now or should somebody pay their taxes and wait until later? And so when you look at the seed or the harvest, here's what this means. I typically ask someone, I say, hey, listen, let's say you wanted to open up a vineyard, right? You wanted to start growing some grapes because you wanted to start selling wine. And you came over and you said, hey, Mario, listen, can I buy a bag of seed? Sure. So here's your bag of seed. And I say, well, listen, you have two options when it comes to taxation on this particular seed. Either A, we can slice this bag open right now. We pay a little percentage of tax per seed right now, and then we're done. Or B, take the bag. Pay me later, right? But later, you're not going to pay per seed. You're going to pay per grape. Why does that matter? Well, because one seed creates a vine, and that vine creates thousands of grapes over the next year after year after year. So would you rather pay one small tax now or pay thousands of taxes later off of that one seed because now it's just thousands of grapes? So that's the idea. Most people, and at this point in the presentation, I usually ask for a volunteer. So like, let's say I'm like, so Amber, would you rather do the seed or the grape? Most 9.5 out of 10, they're going to say, I'd rather pay on the seed. You're right. It is more wise to pay on the seed, right? Well, then, Amber, why does everybody pay on the grapes? Okay. What do you mean? Well, here's paying on the grape. So let's say you made $100,000 a year, okay? And your job allowed you to put $10,000 a year annually into a tax-deferred product like a 401k or an IRA. That means that when you do your taxes that year, you're only going to claim $90,000 in income because that 10 grand is not taxable till later, right? So you're deciding to pay on the grape later. Well, what does that mean? Well, if the current tax rate is 33%, okay, which it is now, by contributing 10% into a tax-deferred account, you basically bypassed paying $3,300 in taxes right now this year, because that 10 grand, you're not paying 33% on, so you're gonna say, I'll just pay that later. How many of you guys know somebody who puts an insane amount of money into their 401k or their IRA every year with the intention of not paying taxes this year? I know a lot of people do that. They're like, oh man, I put a lot into my 401k so that this year I don't have to pay taxes, okay? Keep that in mind. A lot of people do this. This is their tax strategy. Now, let's say you keep doing that. You put $10,000 every single year for the next 20, 30 years, and now it's time to retire. And you have $700,000 in tax-deferred retirement in that account. There's a typo right there. Just saw that, okay? So now it's like, hey, now I want to start taking my money out, okay? So if the tax rate was still 33%, you would say 33% of 700,000 is $231,000. That's what you would owe, leaving you with only $469,000 to retire, right? Well, Mario, isn't $469,000 a lot of money? Well, what if you needed $70,000 a year to live? Okay, you'd be able to stay retired for like 6 years, and then you're back to work at Walmart, right? See, this is because you took a huge tax liability later. So when you compare apples to apples, the question is, should I have paid $3,300 every single year and then built something that's tax-free and then drew out on it tax-free later? Or should I save $3,300 a year right now and then have this massive tax liability later? But let me ask you a question, okay? So, hold on. Yeah. So this is the next question that we ask. Increases in taxes. How many of you think that taxes are going to be higher, the same, or lower in 20 years? Type in a number 1 if you think they'll be higher. Type in a number 2 if it'll be the same. Type in a number 3 if it'll be lower. Let's see what people say. Yep. Number 1, everybody believes taxes are going to be higher later. Okay. So if that's true, I always tell people, listen, let me share with you why we know it's true. Tax experts believe that Social Security is about to run out by 2030 to 2037. How many of you guys remember the Social Security training that we did? You guys remember that? It just literally, it's just math, right? Think of your own personal account. If you deduct and use debit more than you bring in long enough, you'll be broke. Right now, Social Security is being debited way more than people are putting in. So it's going to be gone. And in order to save Social Security, taxes must double, right? That's number 1. We know that that's coming. Number 2 is this. Should President Trump not pull it out here, in 2026, his 2017 Tax Cuts and Jobs Act will expire. And that will raise everyone's tax bracket back up by 4%. So I just said to you, the tax is at 33 now. It'll double to save Social Security. Now we're at 66 plus 4%. If the tax increases go back, now we're staring down the barrel of a 70% tax rate. Now, I always want to say it when I get to this slide, though. A lot of times people say, Mario, you're just trying to use fear tactics. That's not true. Well, go ahead and write this down. Later on, Google the last 100 years of tax rates. You'll see that there were 3 decades, right? The most recent was the 70s, where the tax rates were over 90%. So even right now, sitting here today, when you guys think that taxes are high, they're actually relatively low. So going to 70 is not unheard of, okay? We've paid 90. Okay. So now let's do that same illustration. Let's say you put away $90,000, or excuse me, you put away $10,000 over the course of your career, and now you're ready to retire at 70,000 or 700,000, but the tax rate isn't 33 anymore. We all agreed taxes will go up. So if the tax rate is 70, you're going to pay $490,000 in taxes, leaving you 210. So let me ask you a question. Was it better for you to pay $3,300 every year on that money and then invest it into something that's tax-free, or wait, pay 70% later, right? It's just math, guys. So here's the problem, right? Traditional thinking says, okay, well, Mario, what can I do about that? What does everybody think they have to do to save in a tax-free way? Roth IRA, okay? And Roth IRA is not a bad product, okay? But it's not the best product. Here's what I mean. Some issues with Roth IRA. Number one is this: maximum contribution limits. You can only put a certain amount into a Roth IRA every year. I think it's anywhere from $6,000 to $7,000 depending on your age, and it might be a little bit. It might be right in the middle, $6,500. But I want to save more. It's $6,000. I want to save more than $6,000. You can't. It's the minimum. I mean, that's the maximum. You also have to make a certain amount of money. So if you don't make over 120 and below 165, Roth IRA is not eligible for you. You're not able to do it. Okay. The other is there's fees built into that. Okay. You also have exposure to loss. So imagine you're saving into a Roth IRA for the next 10, 15 years, and then there's a crash. Everything you just did is gone. Okay. So, and then you also have liquidity restrictions. So that means I can't do anything with this money until I'm 59 and a half. So while Roth is not a bad product, it's not the best product. So let's talk about, see, this is the traditional way of thinking. Let's talk about what the wealthy do. Okay. See, the wealthy use 7702A retirement plans, right? And there's a couple of them. So 772A is a tax code that tells us that money that is inside of a life insurance policy grows tax-free, okay? It creates tax-free cash value for you to use now, or it creates tax-free retirement income for you to use later, right? Depending on the product that you select. Now, a small portion of your monthly premium pays for your death benefit, and the rest builds cash value. See, that cash value component grows based on the performance of an index or with a fixed rate plus dividends. You can decide. So there's a lot of flexibility. Time out. Are you seeing that I'm kind of talking about both? I'm talking a little bit about an IUL. I'm also talking about participating whole life, because I want you to get to the point where they want to do the financial needs assessment. And then once you see the numbers, you can decide what is the best route for them. Does that make sense, guys? Okay, so you are guaranteed against market loss, so you have zero risk. This sounds a lot better than the traditional route of what everybody does with the Roth IRA, doesn't it? Right. So now let's talk a little bit about it. I always say, don't trust my word, though, right? Why don't you ask the bank what they do? How many of you guys have heard of BOLI, bank-owned life insurance? Okay, so bank-owned life insurance, BOLI, okay, is basically the amount of money that traditional banks put into the life insurance industry. And actually, as of December 31st, 2023, here's a list of banks and their assets that they have. For instance, in 2023 alone, there was trillions of dollars invested into the life insurance industry by the banks. Mine's number 3. Do you guys see yours? Okay. By the way, this list is like 500 long. Okay. But mine's number 3. Okay. Now, here's what's crazy. The US government issued BOLI restrictions because of the high returns the banks were getting. Why? The government manages and protects against monopolies. And so the government basically stepped in and said, hey, these banks are investing so much money and getting such a high return that we have to limit the amount of money they can put in there. And it's actually at 25%. Okay. So the banks are now limited at what they can put there. So here's my question to my clients. If your bank and mine were getting such high returns investing in life insurance industry that they had to get restricted. Why aren't we doing the same, right? Real simple. Now, next thing we're going to talk about is how do the wealthy fight inflation, right? Compounding interest in the rule of 72. So I'm not going to go through this. We've all seen this a million times, okay? But the idea here is there's two things they do. Number one is they leverage 7702A retirement plans to grow their money tax-free, to hide their money because it's protected, and they also figure out ways to leverage interest as much as possible because they know how to double their money fast. Does that make sense? So with that being said, guys, let's talk about be your own bank. How many of you guys have heard of this concept before? Like, raise your hand if you've heard of be your own bank, right? Okay, it's a very sexy term. Everybody's talking about it. So what does it even mean though, Mario? Well, let's talk about it. So it's actually known as infinite banking, but a lot of people call it be your own bank. So IBC, infinite banking, is about becoming your own bank rather than saving or borrowing money with a traditional bank. This is done by opening a participating whole life insurance policy specifically designed to grow your money tax-free using the IBC strategy. Now, as your cash value policy rises, you can tap into it at any time by borrowing against your money, okay? Now, if the client happens to drop a lump sum in at the beginning, they actually have 90% access or around that within the first month. It's usually even the first week, depending on the carrier that you use, okay? So because the loan that you draw out is secured by your death benefit, okay, you can actually borrow at extremely low rates. So I'm going to share it. I'm going to bring it all together for you guys here in just a second. So the return on your investment is bananas, okay? Notice before it said guaranteed return on your investment. I got rid of the guaranteed word, okay? So unlike stocks, participating whole life benefits do not come with any volatility or risk. You agree on the terms up front with the insurance company, what you're going to pay each month, how quickly your cash value will grow, the death benefit paid to your loved ones. No surprises, no plot twist, just a contract between you and them. So this is a way you can grow your money tax-free and grow your money tax-free and protected from market downturns. That sounds weird. I'll fix that. But the last slide we had on this was a little out of whack. Marita, does this look a lot better? Yeah. Anything else we should add or change or take out?
So what you don't want to say is guaranteed interest rate, but it is a guaranteed return on your investment. So I would put guaranteed return on investment, just not how much.
Okay, perfect.
The percentage, but it's perfect.
Good. All right, we'll keep on rolling. So now we'll talk about liquidity. No credit check or loan application to access your money. You have liquidity just like your savings or your money market account. So your policy can actually double as your as your emergency fund. And that means you're going to get a higher return than if you had in a savings, better tax advantages because it's going to grow tax-free than keeping your money in a savings account. Now you also, to boot, have a tax-free death benefit when you pass on, okay? Interest, dividends, and loans. So when you borrow against your money, your participating whole life policy keeps earning interest and dividends on the full amount. So if I had 100 grand in the actual policy and I borrowed 50,000, the 100 grand is still set in place participating in the interest and dividends that we set up with at the beginning. Now this is because technically you don't pull the money out of the policy, you borrow it from the insurance company, and the cash value is simply the collateral, so that you keep earning cash value along the way. Let me give you guys an example. So I removed the word foresters. I just gave an example. I said currently one of our carriers is offering a 5% fixed interest plus dividends at about 6% on your cash value. That's 11% growth, and then you can borrow against that with a 3% fix. So y'all do the math there. My money is growing at 11%, and I borrow some of it against it at 3%. If you just let it go long enough, the actual interest will pay off what you're paying, right? The interest earned pays off the interest owed, right? I just saw Lisa's face because this is her first time seeing this. That's the face of most people who see this. This is why financial seminars work, because people who've never seen this, they're usually like, what the crap? Are you serious? This is crazy, right? Yep. So let's do what the rich do, right? Let's do what the wealthy do. Okay. They use double duty dollars. They let their money make them money. Okay. They fund a IBC account or a 7702A account. I should put that there. Either monthly or with a lump sum or with both. Okay. Use that money as, use your account value as collateral. Okay. Borrow your money, in the form of a loan from yourself. You pay less interest as the original amount grows. So let me give you guys an example. Let's say you've got 30 grand sitting in a bank somewhere, savings account. Okay. You're like, Mario, that's my emergency fund. Okay, perfect. Leave 10 grand in there, take 20 and go put it into a 7702 retirement account. Okay. So now it's growing at 9, 10, or 11% on a yearly basis. And that 20 turns into 30, turn 35, whatever it is. Then you borrow 15 grand at 3% and you take it and you pay off all your credit cards. Okay. Why is that a good move? Because the average credit card payment's like 18 to 25% interest. I took money out at 3% and I paid off all my credit cards that I'm paying 20% at. But guess what? Did my value, that 25 original that was still there, did that diminish in any way? No, it's still sitting there growing. So instead of paying all these stupid payments to the credit card company, once it's paid off, that money that I was normally sending, I send back here and I pay myself back, right? So the idea is pay less interest while you grow your money. You pay your debts off, you invest that money, okay? You get tax advantages, guys, and you also get a death benefit once it's all said and done. So right here, I'm either going to transition into an illustration, just a very generic illustration like, hey, client A is 42 years old. He put this into it for this amount of years. Here's the cash value. This is what he put in. This is the death benefit. So, right? So I'm going to put that there, which I think I'm going to do either way. And then it gets to the end. Or I might touch on, okay, guaranteed income, because the guaranteed income side of what we do, the annuity side, is a very important part of our business as well. That said, it's 2:31 here. I don't think I went through the presentation for 30 minutes. I think I had like a 10-minute tee up. So the presentation is still only 20 minutes. So I think that it's simple enough, it's high level enough for me to be able to add in the guaranteed income side, because there's a lot of people who want to get involved, but they're not going to have cash on a monthly basis to invest. But maybe they have something sitting out there like an old 401k, an old IRA, an old 403b, and they want to know what to do with that. So I think that that's something that we should add. So that said, let's stop the presentation and let's go around robin. First off, everybody welcome Lisa Looney to the group. She's brand new to the team. Super pumped to have her here. And Lisa, this is your first time jumping on, first time seeing the information. It's actually very valuable because this information is actually what we show to new people. So just not as a new agent, just as putting your eyeballs on a product like this first. What do you think of that presentation?
Honestly, like I actually got like a little like knot in my stomach. Like you're kidding.
Cool.
And
awesome.
I already have like in my mind, I already have, I mean, I come from a Latin family, Hispanic family, very native. A lot of this kind of stuff, saving, investment, a lot of that wasn't even a thing back when my mom was younger, right? Because it was big families, a lot of kids, farmers, ranchers, whatever. So they weren't able to save. But as the generations grew, they all became like trying to save and, build those little nest eggs, becoming in their own careers and whatnot. What's to offer is absolutely perfect for several people in my family. And nice. And with some people who've actually, received like retirement and they did, or received inheritance, and they don't know what to do with the money. It's just sitting in a bank account, like with Wells Fargo. So I'm seeing this and it's like, I like the fireworks are kind of going off in my head and I'm just like, oh my God, like this might not be as hard as I thought it was going to be. Like yesterday, I was nervous when we first talked, because there's obviously a lot of information, there's a lot of products going on, but it's exciting. It's very exciting, and I'm really, really happy to be here with you guys. I'm happy and I'm excited to learn more. So thanks for having
Thanks,
me.
Lisa.
Great,
Yeah,
great stuff.
Marita said the same thing. She was like, once she got off the phone with you, she's like, this girl is a salesperson. She's got an infectious personality, and you're going to do great. We're really excited to have you. Thanks for coming on.
Thank you.
All right, so let's start at the top. Isabel, thoughts, takeaways? What did you like? Is there anything you didn't like? What are you thinking?
I like that it's short. It's a lot shorter. Gives more time to dig into the tailored numbers for the client towards the end. You can use the same presentation if it being an IUL or infinite banking, which is good. And yeah, it's pretty good. Nice and
Good.
short.
Thank you. Remember, this one is set for financial seminars, the group setting. We last week I presented the condensed, like shorter IBC one that you would use for your illustrations, just so that we're clear on that. This one is like if we, like Lisa, when she's brand new and she invites a ton of people in her network, this is the generic presentation for everybody. But we do have one. I think I did it on the Wednesday of last week, and it's on YouTube as well. So if you want to go check that out, but appreciate you chiming in. Tony, what are your thoughts, questions, anything you like, anything we need to add, anything we need to take away?
No, this is cool. I got a really good lead today. So on a group setting, you want to keep people engaged. So the shorter it is, but detailed, the better. So I'm all for it.
Good. Awesome. Priscilla, what'd you think?
I love the combo. Like, I want the combo.
You want the annuity added?
I want the annuity added. I know I haven't done the groups in a while, but like if we were to start doing the financial seminars, like the big group outside of individuals, that's awesome. Are you doing an update on the annuity one at all, or is that one fine how it is?
It's good how it is, but if you have some things you want me to add or things, we can always look into that. I was just on a call this morning with F&G. It was the top producers call that they hosted, and the guy that was on there is really good. And he gave some really good ideas and thoughts, and I was immediately thinking of the script for annuities. I was immediately thinking of the presentation. So we can get together, and let your focus and your specialty, but we can get together offline and talk about that.
That'd be awesome. But yeah, I love the combo. I love it.
Nope.
You always have somebody at one of those 2 points, starting to build, or they have saved something, and what do I do?
Exactly. Good. Amber.
I really like how condensed it is. The visuals, I feel like talk to people, because I know I'm a visual learner, so I like seeing it all laid out like that. I just like how easy and smooth it went, and it's not overbearing. It's not too much information to where they lose interest.
Good. Awesome. Thank you. Sharina.
Yeah, I like the simplicity of it. I was also going to mention possibly adding a diagram of how it works to a repayment plan. I don't know, in either one, in this group setting one, of like if they have a goal to pay off debt, or if they have a goal to start a business, of how they can borrow against it versus explain it, because how Amber just said, some are more of a visual learner. So maybe putting a diagram together of how that works, I don't know, but it looks good and very simple.
Okay.
It was great.
Yeah, I mean, that's it. That's IBC as well, but it's used like in a different strategy. You're talking like the debt elimination route. I mean, think about that, because there's power in that 100%, but I'm trying to figure out, when do we show that? Is that more on the second appointment? You know what I mean? After we find out?
That's what I was saying. Like, I don't know where you want to put it, but somewhere in either one would be great, because some people are just like, well, I still don't get it. Like, people don't understand.
Maybe we do too, because, Maritza and I and Wences have been talking about doing monthly. So like, for instance, like Lisa's new, who else? Nobody on here is going to be doing their but I have quite a few new people, right? They're going to do the financial seminar that you just saw. But some of you guys might be like, look, if you do like an open one for everybody, I could probably get a couple people on there, right? And so maybe we'll do like a team seminar, and one will be wealth strategies of the rich, and then we'll do another team seminar, and that one is debt elimination.
Oh, I like that. I like that.
And then you, because dude, if you guys can't get the debt elimination Zoom filled up, I don't know what to tell you, because everyone and their mom has debt. Even if they just have to pay off their house, say, hey, I'll show you how to pay off your house in half the time, literally, and save hundreds of thousands of dollars in interest if you jump on the Zoom, right? Super easy. All right, cool. Karina.
I like that idea that Sharina just gave for you, like having multiple seminars, because if you give them all the information at once, they won't understand anything, and then you would probably lose them because they are super confused.
Okay.
That part was cool. The presentation, I like it because it's short. And I think it could work for anything, whole life or IUL.
Okay, good. One of the things that I want you guys to and this is not to say anything to any one particular person, okay, is that your clients are very, very good clients. IBC leads are good, okay? You don't close every one, but the ones you do, they're good, right? When you say, hey, I'm going to call you on Thursday, they pick up, right? Or, hey, we've got a client call on Saturday, they get on, right? So don't keep, oh, it's short. And maybe I'm off base here. Don't keep saying, and I'm not talking to you, Karina, because you just said it, like 5 of you said it too. Don't mistake short with being efficient and good, because every person is different. Some people are analytical. And if they're analytical and you go short, you just shortchanged them and you lost them.
Yeah.
Okay. Some people want to know all the details, and they would prefer an hour-long one, right? So again, short doesn't equal good or equal better, right? So even if it's long, if it's simple and it's easy to follow along with, you'll be able to get that. I just wanted to say that because I've heard a lot of people say, and I didn't build this with the intention of being short. I built it with the intention of being simple, right? And it could take you 30 minutes. It could take you an hour. I want simple as opposed to short. So just wanted to throw that out there. And again, not intended at you, Karina, but you were just like the last of the 5 people who said short. So it's okay.
Let's say this. You got a point. Simplify it. You know what I mean? And that's what we, it makes a lot of sense. You know what I mean? Instead of having it so inundated and then you got people just like nodding off, So you're right. Simplified is a better word.
Yeah.
Use.
Good. So. Good. Patty.
It's simple. And it flows well, and it gives you that flexibility to either dive a little deeper or pull back if you don't want to go as in depth. And it addresses more than one product. So when you're doing your F&A with them, you haven't pinholed yourself into one idea or one thought in their head. So you're malleable to present what makes the most sense for them based on their situation.
Love it. Thank you. That's good. Luis, I know he's at work. I'm not sure if he can chime in or not. Oh, he already said, like this version because the illustration helps give a visual, also looks clean, except for the surprised face guy. But yes, it's good stuff. All right. And then the Jacqueline. I don't know if you can chime in.
Hello. Yes, I have
Hey there.
a question, just a product knowledge. I'm trying to categorize things in my brain, but you said you have to get a life insurance for this first, right? So like is the premium
not first.
Okay, so
it's at the same time. It's a life insurance policy.
It's a life insurance. Okay, so is like the premium included in whatever packet they want to get, or how does that work? Or that would be determined by the carrier?
So what happens is this information is given, their light bulb interest gets peaked. You gather everything, all of the information on the financial needs assessment form, okay, at their next call. And then during that time, to your point, number one, how much do they want to put in? How much can they afford, right? So once you dial down to that, oh, I want to do $500 and I've got 20,000 I want to drop in. 500 a month, 20,000 drop in. When you draw up the illustration, okay, the amount of insurance that is needed is based on their age, right? Their height and weight, their medical background, right? So do they have any illnesses? Do they have any ailments? Are they, so it's not a black and white product because there is an insurance component, right? And so you do have the ability to set more insurance into the product or less insurance into the product. But that might be a training that Maritza does. She's up on Friday. Maybe she does another illustration training on that. But it is based on each individual. That's the short answer. Does that make sense? Going once? Going twice? There she is.
Yes, sir. Yes, sir.
Okay. All right.
Sorry, I'm trying to do all this
The queen
stuff.
bee jumped off right before I was going to call her.
Okay.
All
Thank
right.
you.
No problem. Wait, you just asked the question. Did you have anything else?
No, I just I've seen this. Oh, I know you kind of like made it simpler. I think when you were talking about the short, when you were talking about that, and to me, I was just thinking quality versus quantity. So I think, as long as the quality's good of the product, like that's better than saying, oh, it's long or it's short. That's kind of what just clicked in my head.
Right. Cool. All right, guys, that's all we've got for today. Thank you, Jacqueline. Thank you, everybody, for jumping on. And I just got a message. Maritza had to go for an appointment. But otherwise, tomorrow at 8 a.m. Pacific, 10 a.m. Central, our wake-up call. Otherwise, God bless. Have a good day. Talk to you soon.